Jakey, look, you're a senior commercial valuer with one of the large firms in Australia, and you've got a lot of history that we can tap into. And valuing commercial property is not as easy as I guess people tend to believe. There's multiple different methods. So, what are the main valuation methods for commercial property?
Yeah, look, it sort of depends on asset type, and but look, generally speaking, you've got the primary approach in most investment cases would be capitalisation of net income. So that's essentially looking at the net income of the property, and then we look to the market for yields essentially. And depending on market conditions at any time, obviously yields could be firmer or softer. And then obviously yields will differ between types of assets, and depending on a whole range of factors. And then we have direct comparison, which essentially you could looking at a rate per square meter on building area, lettable area, net lettable area. And they're probably the two primary approaches that we do. There are some other approaches. Summation approach, which is essentially just what's the value of the land plus the added worth of the buildings. And then for some of your larger properties, like big multi-tenanted assets, we'd be looking at sort of discounted cash flow modelling and IRRs and things like that, but less common in the work that I do, sort of your standard commercial. But yeah, so they're the primary approaches.
Thanks, Jake. I'd love to break down those first two, or those primary two.
Yeah.
So you're saying, just like from the lens of somebody that's listening, is like, I've got some commercial property and I'm starting out in commercial property, and they want to move into, like, let's get me to the commercial route and cash flow when they can, when it's feasible to do so. And then, like, I just heard you say, all right, for the first approach is you're getting the net income from the property, and then is it correct in saying that you're going to the market, in that local market in that area for that same asset type, and looking at what the yield rate is, and then sort of coming up with a valuation from that? How do you get a bit more specific around that explanation, I guess? Yeah,
so like the way that we would sort of break this down is, so first of all, we look at the rent. So just taking a very simple single tenant property example might be, say, an industrial unit that's tenanted. What is the income of this property? And typically what we do is we look at the gross income. So a lot of leases are struck on a sort of a base rental amount plus the recoverable outgoings. So we can basically consider this gross rental amount, and we would make an assessment about whether or not it was at market or not. So whether it was essentially, because sometimes you get these situations where the rental's really inflated for whatever reason, and that's something you have to kind of look out for. But essentially, you take your gross income, you take off the outgoings of the property, and that gets you back to your net income. And then, essentially from there, it's all a function of yield, which, exactly as you said, we sort of look to sales evidence to demonstrate what yields have been achieved in the marketplace. And obviously yields will differ. So basically we had a situation during COVID where we had a lot of interstate investors investing in the local Gold Coast market, and basically some of the reasons for that was the yields on the Gold Coast were quite attractive on a kind of national basis compared to what, say, someone in Sydney could get. They were a lot firmer, so the returns on the Gold Coast were more attractive. But yeah, does that kind of explain that first approach?
Yeah, I get it.
Yeah.
By firmer, you meaning lower? So
lower, yeah. Lower, stronger is probably the best word.
Well, the way what do you
mean by that? So when you say that, Sam, like, just for us listening, like firmer or stronger, what does that mean?
Yeah, well, people are willing to pay more money for a same amount of income, right?
Yeah.
And that's what changes that yield component. And in Australia, there's obviously markets within markets. So Sydney and Melbourne have a firmer yield rate because it's just more established, and people see that as lower risk, right?
So a firmer yield is a yield that is lower yield. Like, say, like a firmer yield would be 5% when the average might be 7%. Is that correct?
Yeah. So essentially, someone's willing to accept a smaller return for the asset for whatever perceived. Generally a yield is like it's sort of risk tolerance. So, yeah, that's essentially what it comes down to.
Yeah. Yeah, it's a bit to get your head around, and obviously that's why I want to get Jake on the pod so the two of us can throw a few things out there. But Jared's really, he's very interested in this commercial space, and we're touting whether this next purchase for him is to commercial or to build on his residential portfolio. So it's good, for Jake and I, obviously the numbers just sort of rattle around in our head and the language comes out. So Jared, I'm really I'm interested to see the questions that come out of you today, my friend. But the simple form that I try to look at it from the commercial base is, people are looking at that income play. It's a strong income investment, and it's just from a risk perspective. People will have this mindset of, well, Sydney, Melbourne, I'm happy to park my money there because I have a feeling it will increase in value greater, and I'm willing to take a lower income. So that yield component, which is a direct reflection of risk